Ladies and gentlemen, welcome back to the channel. Today we had a lot of big news for Tesla, including price target upgrades. Some analysts are getting even more bullish on Tesla. That's awesome. We also had news that Xiaomi, the smartphone maker in China, is coming out with a direct competitor to the Model Y that is priced cheaper than the Model Y. Seems like Wall Street kind of brushed that news off a little bit today. It kind of affected the stock during periods of the day, but overall caused a lot of volatility. There was also news that two senior executives have left Tesla in the past week, one of which seemingly left. She was the head of the HR department, which I don't know how big of an HR department Tesla ever had. Okay. And then there was news of a longtime executive that left Tesla as well, that was fired by Elon Musk, that worked directly with Elon. One to a handful of people, a couple dozen people to an organization does not make or break that organization. And again, we've had a lot of these departures in the last couple of years, and they never are long-lasting catalysts for Tesla, or negative catalysts, that is. And I don't think that will be the case this time around. Now, here in this video, we will discuss the economic data coming out tomorrow, but most importantly, the direction ahead for this market and for Tesla. I'm going to share with you some clips from CNBC from Ryan Dietrich and another individual that kind of share with you what the month of July normally looks like. The month of July is actually the strongest month of the year. Over the past 10 years, the average return in July has been over 3% for the S&P, which is exceptional. For a stock like Tesla, that should mean some pretty nice returns over the next month or so. But even into the end of this year, things look very constructive for a larger rally. Again, consider the S&P hit a new all-time high today. Like, that normally is when you want to go long in markets. Like, if there was a moment in the past couple of weeks to be long this market, okay, great. You were either long or you weren't. But getting a new all-time high is actually the confirmation of the rally, right? It's the confirmation that this is not a bear market rally, that this is something that can be a longer lasting rally. And again, I think we're going to hit 700 on the SPY by the end of this year. That's about a 15% rally from here, fueled by AI optimism, by a focus on 2026 and a new Fed that's coming, that's a little bit more competent, that we're going to see a lot more rate cuts, which obviously, will help to, in theory, boost markets higher. A situation where we don't have any inflation, and we have an okay to decent economy. I think with that backdrop that we have right now, that should be a very constructive backdrop for markets, and specifically for AI, where you're going to see a lot of growth over the next 6, 12, 18, 24 months. I think there's going to be a lot of people rushing into AI stocks, and I do believe over time, markets will realize Tesla is the epitome of your ideal AI stock in terms of like what robotaxi is doing. The market size of robotaxi is almost incomprehensible on a global scale. It's massive. It's almost, unending in terms of the total addressable market for robotaxi over the longer term. Question is, though, we need answers around scalability of robotaxi. Is this, a city by city kind of Waymo launch, or is this something that could be really expedited and be a lot faster? Is Tesla going to eat Waymo's lunch? In other words, is Tesla going to be the top company in this field and rapidly expand? Or is it going to be a slow and steady, a couple hundred vehicles here, a couple hundred vehicles there, something that doesn't really move the needle for Tesla? There's a big difference between what will happen to the stock in either one of those circumstances. So that's the preference I want to give you. I'm very optimistic on Tesla. I think Tesla is going to be a $600+ stock by the end of this year. And nobody could convince me otherwise. I make bold predictions. I make bold claims, but that's the claim I'm going to stick with. Again, with the caveat here that if Elon or the Tesla team on the earnings call that we're going to get in about 3 weeks from now, throws doubt on the scalability of the robotaxi, if they don't give us clarity on the scalability, it's going to be difficult to hit $600 per share by the end of this year. I think we're going to get some pretty optimistic numbers for next year. I think Elon Musk could say anywhere between, 20 and 100,000 robotaxis out on the road next year. Either one of those numbers or anywhere in between is going to send you to new all-time highs by the end of this year. Okay, that's my view. Again, even in the short term, I think Tesla could very soon here be above $400 per share. Now let's get into these clips from CNBC and the economic data coming out tomorrow morning. Tomorrow morning's economic data is huge. Now I do want to share with you a couple of clips from CNBC. This one is from Ryan Dietrich. He says July is the best month for stocks in a post-election year.
Good to see you. What's your word of the day? We got to jump into this thing, Ryan. It's always good to see you.
Good morning, Frank. Thanks for having me back. I thought it's almost July, so we're going to go with fireworks because, listen, people are going to hear a lot about this. The month of July, Frank, has been higher the last 10 years in a row for the S&P 500. It's the top month the last 20 years, and it's the best month in a post-election year. And one more for the listeners. When you're higher in May and June, like we're probably going to be with June because we're up pretty good, July does better, and the final 6 months of the year have been higher 15 the last 16 times. When these weak months are strong, like we're doing right now, that could be a signal this bull market's alive and well.
All right, could be a signal. By the way, we're going to go over this data real quick. Over the past 10 years, in July, the S&P is up about 3.33%. So it's a pretty significant upside move. I want to ask you, what do you see moving us higher? So tech's at a record. Do you see that continuing to break records? And then also we have consumer discretionary, the laggard. Do you see a reversal there? Where do you see the upside moves coming to push us to newer and newer highs in July with a potential 3% upside move if you look at historical precedent?
Yeah, those cyclical areas, we've liked them for a while. Come on with you saying that. Your financials, your industrials, technology, those are the areas that you want to see leading. And what's lagging? It's the defensive stuff, right? So that's a positive market. It's like signals and clues. Those are things you want to see leading in a healthy bull market. We think those areas got us through the dance. They're going to keep leading us in this surprise summer rally.
All right. So, people always look for picks in this spot, Ryan. I know you don't pick stocks, but in general, if you're looking for opportunities to ride this July rally, what would it be?
Momentum stocks. We like those momentum stocks. There's momentum ETFs out there. Those are some of those areas I just talked about in healthy markets is what you see. And again, one more thing on this, Frank. I don't see a lot of optimism. I get to travel the country, talk to people. People are like, I'm still kind of worried. That is a good thing. So those momentum names could do really well in July, maybe even in the rest of this year. Momentum's up 14% for the year. I don't think most people realize that. It's probably still going to lead, Frank.
All right. Really quick, Ryan, when you're talking about momentum, and I'm not asking you to pick it, but you're talking about things like the ARK Innovation ETF. We hit this earlier in the show. Holds things like Tesla, Circle. Is that generally directionally when you're talking momentum?
Not so much. We like the momentum ETFs like MTUM, the S&P 500 momentum ETF. So although Kathy's doing a pretty good job, and if you're hot, you're hot. So those are doing pretty good right now too. Wow,
that was pretty incredible. July just tends to overall be a very strong month, and to 3+% for the S&P in July is ridiculous. Now, some of his other stats are pretty wild as well. That would put the SPY in the 630s range. 3.5% upside would put the SPY in the 633-ish area. Yeah, I agree. Momentum is definitely the place to be. Now, I also want to share with you this clip from CNBC. It says a broadening of the market is beginning because I believe, actually, believe it or not, small caps are probably a good area to be in as well, specifically small caps in the AI sector, because that's where I think we're going to see hyper levels of growth, right? There's a lot of investments into AI names. And I think some of the small cap AI names are kind of underlooked right now. As we, start to focus more and more on 2026, a new, Fed chair coming in and more interest rate cuts, I think this is really an area that can shine. Now, if you guys want to come, get access to all of the research that I am doing, the due diligence that I am doing and posting in the trading community, along with the stock picks that I am making trades on and investing in. A lot of these are 6, 12, 18, 24-month time horizon trades, not day trades on some of these small cap AI names, some of these smaller cap biopharma names that have big catalysts right around the corner that are underlooked. check that link out down below in the description of this video. That's what I am doing. That is the service that I am providing. I'm spending hours every day sifting through small caps, the bad ones, the good ones, all of them, to find the opportunities, to find the next 50 or 100x stock. You know, that's the idea of the trading group. It's not about making 7% a year. It's about, you know, yes, taking a little bit more risk, but taking a calculated risk, okay? If you do enough due diligence and sift through the good and the bad small caps, you know, one small cap may have a lot of risk. Another small cap may be so underpriced that people would think it's risky, but maybe it's not as risky as it appears to be. So it's the balance between trying to find the next big stock or a big potential returning stock, while also saying, hey, this company is doing XYZ, it's trading at XYZ valuation, it's in XYZ field like AI, for an example, that all of a sudden lowers the risk profile of that stock. So there's a lot of criteria that these stocks that I am investing in and we are, you know, investing in for the medium term have to meet to actually even qualify to go in the portfolio. And that also takes a lot of work as well. Check out the link down below in the description of this video if you would like to join. But let's take a listen to this clip on CNBC because I think it's very applicable to where we are at right now with markets that just hit new all-time highs.
A senior portfolio manager. No, we looked into the abyss when I think the S&P got down to, God, was it 4,800? I don't know where it was. We're almost all the way back to new highs. More new highs, or now we look around and say, okay, what do we do? We're back to where we started the year, basically. Up a little.
We're up just a little. So, I mean, from the abyss, we're up a lot, obviously. But, just for this year, we really haven't done very much, only up about 3.5% or so. So I think we can go higher from here. I think economic growth is okay. It's a little bit slower than it was. Rates are obviously too high. Having said all that, it feels like, from what we're hearing anyway, that businesses are on track. Some business that didn't close in the first quarter is beginning to close now, and it feels to us like the economy is doing okay. I think we're looking at heavy investments in AI, we're looking that's going to continue, but we're also seeing a little bit weakening of the labor market in here. So, I think there's a lot predicated on some of the decisions that get made. We're of the belief, obviously, that the Federal Reserve's rate level is too high right now, especially given where the labor market is. But as we get these two cuts, this year, at least two cuts this year, I think as the residential investment is going to be critical for overall GDP growth, because really, if you're looking at CapEx spending in the U.S. today, it's really almost all driven by what's going on in AI and in technology. And residential investment has been tough. You're going to have down housing prices this year if rates continue this way. So we think the economy is on a good path, and we think the Fed should be a little bit more accommodative than it currently is. But the markets can definitely work higher as the economy continues to gain confidence. As I think continued deregulation happens now that we've sailed past the most difficult parts of tariffs.
Do you expect to see trouble ahead in the numbers based on the tariffs? I'm talking about the inflation side of things. And you said, yeah, the economy's doing well, so I think we could have some cuts. That doesn't make sense. You mean we could have some good cuts because there's no inflation?
Correct. There really is, and I think real rates, by holding real rates and having inflation continue to decline, de facto they're continuing to raise real rates, and they're continuing to run off the balance sheet. So, you're in this period where they're continuing to de facto tighten, which really doesn't make any sense. I think the inflation numbers are good. Look, there isn't a central bank, and these tariffs are a tax, right? So in 2018, the Trump administration's tax cuts came through, and the Federal Reserve was going to go well above neutral because tax cuts were inflationary. And now the tariffs, which are taxes, on foreign goods. Tax hikes are inflationary. None of it makes sense. This idea of waiting for this pass-through doesn't make sense either. You're either data dependent or you're not. Right now, where rates are would suggest you should cut. If there's massive pass-through and lingering inflation that goes on 6 months or a year from now, you can raise at a later date. Right now, this wait and see approach, given the labor markets, you've seen unemployment tick up 4 months in a row. It doesn't seem to make much sense. I'm not really. Their arguments are fairly weak here. I think arguments made by people like Waller more recently have been much more aligned with where I'm at in terms of, you could probably cut sooner given the progress made on inflation and the lack of pass through thus far. Basically 0 to 525 basis points of Fed hikes in a very short period of time. And so we've had gains in the last few. So I think it's going to have to be earnings driven. We're looking next year for something like $300 of earnings power for the S&P 500, maybe $400 of cash flow. So 20 times earnings, 14, 15 times cash flow, not crazy expensive, but not certainly cheap. And so the leg that has to go on here are companies being able to meet or exceed those expectations and deliver on growth. So, I think if you look at the market overall, you'll find pockets of opportunities. And I think a broadening of the market is beginning. Was derailed in the first quarter, but it's beginning. And so, for us, I think that there's plenty of opportunity out there in the overall market. In general, the market's fairly valued, but there are certainly pockets of opportunity. Even in some of the bigger names, NVIDIA more recently has been going sideways actually got relative to its growth to a reasonable multiple. We also think the financials can continue here, both based on deregulation and then what we think is going to be a really interesting opportunity with the Genius Act and other legislation on stable coins and sort of new payment networks. Plus, I think a lot of the banks and a lot of the financials will be able to employ AI for a lot of the processes they have today and see tremendous cost savings. So there are certainly areas where we think there'll be margin improvement and earnings improvement over the next few years. And that's what we're trying to focus in on.
So yeah, I will say it is a bit refreshing to hear some bullish takes out there, some takes that are kind of in line with what we've talked about here on this channel, because a lot of people have been bearish on markets. And I guess that's what happens when you fall 20% and there's a lot of uncertainties out there that continue to linger. Now, tomorrow we do have very important economic data coming out. That is core PCE month over month. You're expecting 0.1%. I think there's a good chance we could actually come in at 0.0%. The last 2 months now have been at 0.1%. So getting a 0.1% number or even a 0.2% number if it comes in high is definitely not an issue at this point. Assuming it comes in at 0.1%, again, it's further validation the Fed should be cutting rates and that the Fed is really just delusional at this point, that they have lost competency. The Fed has effectively switched from a data-dependent approach to an opinions-based approach. And I mean, we can all see why now Trump is so frustrated with the Fed. At first it was like, okay, let's wait and see what happens with inflation. I can get behind that if we only had one good inflation report. Now, tomorrow morning, you're going to be approaching 3. Well, you're going to be at 3. And then it's like, dude, we should probably be cutting rates if we're 2.5%, above the inflation rate, right? If rates are 4.5%, PCE is at 2.5%, we should probably begin cutting rates. And the Fed, it's kind of delusional there. And that's why I think Wall Street's going to start focusing more on what the Fed composite is going to look like next year in 2026 with a new Fed chair that will be coming to the Fed. Now, we will also get personal income month over month tomorrow, expecting 0.3%. That would be a great number in line with closer to 2% inflation. And personal spending month over month is expected at 0.1%. So best case scenario, you want a low PCE report, a low personal income report, and a high personal spending number. That would be, the most ideal situation you could really have. But I think from my perspective here, again, I was calling for new all-time highs this week. It happened. And the odds are fantastic that we're going to get, more new all-time highs, that markets are going to continue to rally. And as the individuals in these clips have told us, You know, July tends to be a really strong month for stocks, and I would not bet against that at this point. I also think a broadening is likely coming with more, interest rate sensitive stocks that likely start to do well, and maybe some smaller cap names. Again, with the backdrop of everything we have talked about and you guys have seen in this video, I think personally you really want to be long this market. It's hard for me to imagine more fear from here, right? Think about the trade war that we started this year with 145% tariffs on China. Like, what is worse than that? That's really going to knock us down, substantially again. Or the tax bill. Like, we've gotten all of these big negative things out the way. We attacked Iran. You've already seen so many fear catalysts this year that, what's it going to take next to really wreck this market? Is it going to take an asteroid that sets course for America? Let's knock on wood that does not happen. And this is real wood, by the way. I know people always say that. That's not real wood. That's real wood. It just seems hard for me to imagine markets getting as fearful as we just were. We've come out of the fear, and I think there's a lot to look forward to, especially in AI. And I keep coming back to this because, my thing in markets is, yes, I like to find the small cap underappreciated stocks. They don't have to be small caps, but that's typically where you have the underappreciation, where you have less analyst coverage, less retail investors that back them. I like to do that. I like to find hidden gems. I like to find stocks that can have 10, 20, 30, 40, 50, 100x opportunity with a lower risk profile. Typically, when you're looking for stocks that can 100x, you're going to take on a ton of risk. You're going to be, taking on massive amounts of risk, okay? To invest large amounts of money in those kind of companies is, there's the pros and cons, but the risk is very large. With the due diligence that we are doing in the trading community, for an example, I'm looking for companies that maybe offer a less risky way to do that. For an example, you could look at a biopharma name. There's a couple in particular I have invested in recently that have already put out exceptionally, strong numbers. Sure, there's still a lot of risk in those, but it's a little different than, maybe another company that's all hyped up in the biopharma field that hasn't released any data yet, right? On some of their ongoing human trials. Things like that I'm trying to find, but I keep circling back to AI because there's going to be a lot of growth in this field for a long time. And I think the markets are dramatically underestimating what the next couple of decades are going to look like for some of these AI companies. Tesla, be it at the epicenter of it all. Because what really matters is the total addressable market. That's the only thing that really matters in investing ever. Apple could have never become a $3+ trillion company, no matter how good their product was, if they made freaking snow globes, okay, for an example. There has to be, and I was looking at a snow globe, so that's the first thing that I thought of, or cups or whatever the product is. There has to be a total addressable market that can, sustain or allow a company to grow into some incredible valuations. That's part of the puzzle as well, trying to find those small cap big winners. It's got to be a market that you can actually grow into a 100x opportunity. Now, again, for Tesla, robotaxis, almost unlimited growth. Humanoid robots, literally unlimited growth. I'm sure there's a limit on it, but we'll never see it in our lifetimes, okay? And the more Wall Street starts to figure that out, that Tesla is the epitome of your ideal AI stock, the stock's going to rally huge because especially as we start to get rate cuts, the economy holds up, a new Fed, we have all of these fear catalysts out the way, the spending bill, when markets really realize what's going on at Tesla, they're going to say to hell with Tesla's valuation today, because 5 years from now, Tesla's going to be bringing in, $30 of EPS, let's say, something like that, then Tesla's valuation today looks very cheap. Again, valuations are based on expectations more than anything else, because anything can happen in the business world or in the economy. So again, that's kind of in a nutshell why I'm so bullish on Tesla here. That's why I'm so bullish on AI. And again, I do think there's a lot of opportunities in small caps. If you guys want to come trade with us, check out that link down below in the description of this video. I do all of the due diligence, so you don't have to. If you would like to join that group and get involved and do your own due diligence and share it with the group, that is always welcomed as well, because the hardest part is really just the time, like going through companies all day, hours and hours and hours on end, and realizing 98% of these small caps are garbage and you should not own them. They're in the wrong field. They're not growing. Their product, doesn't make much sense. It's going to be obsolete in a decade because of AI, whatever the reason is. 98% of them suck, but there's like 2% of those small caps that are going to be huge winners. And we're just finding those, locking in on those opportunities. So let me know, again, your thoughts on this down below in the comment section. Have a great rest of your day, and I will see you in the next one.